Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, for listening to us. We bring to you each and every week information about mortgages, the real estate world, what's happening in the economy, and how those things that are happening outside of your control are going to affect your decisions. That's kind of what we talk about, certainly in a couple of sessions, couple of different sections that I am the only guy here on the show. And then for the rest of the show, we bring in some guests that talk about programs, what specifically is going on in a particular market, and also today we're lucky enough to have in some commercial people, because the commercial real estate sector and section of our economy is something that we don't really hear much about unless you're in the business. Certainly if you're renting office space, and one of the few that are left doing that, or you're in other kinds of commercial space, whether it be hotel or leisure or storage space, personal storage space, large warehouse space. All these things are commercial real estate. Now, in the non-QM sector, we talk a lot about DSCR, which is really a commercial loan. What does that mean? It means debt service loan, so that if you're buying a 1 to 4 unit building and the rents on that particular unit can cover the debt service, well, then you don't need to come in with anything, and you don't need to prove that you can pay, because the rents are going to pay. Other than that, the sector that we want to talk about mostly is office space, and why major cities around the U.S. are having very, very difficult time coming up with a way to be able to deal with those large office buildings that are continually and probably in the future going to be a lot less occupied than they are currently. So these are the kind of things we want to talk about today with Tyler when he comes on. Let's see. So if you want to see me on the screen, on the big screen or the little screen or whatever screen you're looking at, go to YouTube, Jeff Barton, the Mortgage Voice. I'm there. And I'm there through, I don't know, the last 8-9 years. We're talking hundreds of shows there, past shows that we have. I've yet to be doing, in the last 2 or 3 weeks, maybe a month, the short videos that we do on LinkedIn or YouTube or Facebook, Instagram, all these types of things. And one of the reasons I haven't is because we had such volatility in expectations, both from the buyer and seller, as well as the market conditions and how we've seen rates go up and down like a yo-yo. Terrible. But anyway, Jeff Barton, the Mortgage Voice. Go to YouTube, see that, and you can see, like I say, a history of things that I've been doing and what happens lately. Okay, so let's get to what the rates are, where they're going, and what they are expected to do for the rest of the year. I say the rest of the year with tongue-in-cheek, meaning that we can't really see around the corner, let alone 6-8 months from now, but I'll give it my darndest. Okay, see, 30-year fixed rate loan, 6.5%. Last week, we were at 6%, so it's gone up half a point. Now, that may mean nothing to anybody who isn't in the mortgage purchase, meaning you're going to buy a house and you need to get a loan. But on $100,000, half a point means that you're probably spending $500 extra a month to get that mortgage, and it only happened, over a week's time. Next week, it could be 7%. The week after, it could be 6%. It's just up and down, and very problematic for someone who needs to be saving and planning and looking, because you can't figure out what your affordability is unless you know two things, right? You have to know what you make, and you have to know what you're going to spend. And these things make up your debt to income, and those debt to income ratios are ironclad, especially when you're talking conventional, when you're talking government loans, when you're talking, things whereby you can afford. Obviously, if you can't, and you can't figure that out because the rates keep turning from low to high to high to low to medium, and each week it's a mess. And I do feel for you. I understand it. You need to have somebody really there for you to be able to, lock in as quickly as possible, especially if you're in a purchase contract already. Okay, so the 15 years at 5.9%, the FHA is at 6.15%. The jumbo is at 5.99, and the 5/1 ARM is at 6.68. I have here in my notes, rates Rates back up mid-sixes for top quality borrower. And that's the other thing. I'm quoting these rates. And again, every time I quote a rate, it's really an average. And I get a lot of these rates through Mortgage News Daily. If you want to find out for yourself what the average rates are, especially across the U.S., just so you can be in to have a conversation without any expectation by you or your mortgage broker so you know what's going on, go to Mortgage News Daily. It's a pretty good site, and I like it. But these rates that I'm quoting are for the top quality borrowers. You've got, high 700, low 800 FICO scores. FICO scores only go up to, 840? And so if you've got an 800, okay, you're in. If you're making enough money to qualify for a 20% down type loan, all right, you're a top quality borrower. And if you have a long history, a good credit, money down, and the ability to prove out that you can have that job and continue to pay that loan for the next 360 payments, you're going to get these rates. That's right. If you don't, you're not. So, again, rates are making you crazy. I get it. And right now we're in a very volatile up-down market. Couple news items here that I want to get to. We talked a lot about mergers, about consolidation, about layoffs in the mortgage world. Just like the tech world, the mortgage world is going through a huge upheaval because, hey, with these rates and the problems that I've just laid out for you, it's a wonder a lot of us are still in the business. Now, I'm in the business. I have a company called Malibu Funding, Inc. We've been in business about 21 years. We've built up reserves and a lot of different credit and things that if you're in business that long in any business, you're going to have a lot of goodwill. Well, we're one of the companies that has. But there are tons of companies out there that have goodwill that have decided to bail or get out of a certain area in the market. Now, we do business with a company called Homebridge. Homebridge is both a retail and a wholesale division, and they also have REMN, Real Estate Mortgage Network, which is more of an East Coast thing, although they do things out here in the West Coast as well. Well, they've decided to pair off their retail division. Now, a lot of these lenders that are non-depository lenders, what does that mean? That means I get to borrow money from somebody and then lend it out to you. I don't take deposits in like a bank, but I act as a bank in every other capacity when it comes to mortgages. This particular company, which has both a wholesale, which is what your mortgage broker will go out and shop to, 30, 40, 10, 20 different mortgage companies to get you the best rate, the best program, but a lot of those particular type of lenders, wholesale lenders, also have a retail branch, i.e., Homebridge has a bunch of guys, bunch of gals sitting around a desk in a big office, and they're calling or making loans for customers to come in the door. That's a retail. Well, they've decided to sell off their retail branch. And one of the reasons they do that is because having in-house retail is expensive. You either got to pay these people a high commission or you got to pay them a base salary. And depending on exactly how you set up your business, hey, we all know that overhead's killing businesses right now, especially in the mortgage business, which is why Homebridge decided to sell off. A lot of independent banks out there are losing money on loans. There was a great article on Housing Wire, another great site to go to, although I think Housing Wire you have to pay to see. You have to pay to play, so to speak. So if you want to see their information, it's not that expensive, but unless you're in the business or you're really, really interested in knowing more about the housing market, the mortgage market, from housingwire.com. Anyway, what do they say? Banks losing money on mortgage loans. And they said that small to medium-sized banks are the banks that are doing 80% of the mortgage loans out there. They're losing, on average, about $300 a loan. Now, you may say, oh, they're losing money, $300 a loan. How can they stay in business? That's exactly right. So what they have to do is churn the money and go to their reserves in order to keep the doors open and hope that at some point this year, the Fed will decide to drop their short-term interest rates. Now, I know it's not symbiotic, but it is tangential that you might find mortgage rates dropping at the same time. Why? Because it just seems to be that when certain aspects of the economy get geared up, that the other sectors of the economy gear down. And that's what happens when the Fed lowers interest rates, meaning that the member banks don't have to spend as much in liquidity to shore up their reserves. That means usually that they want to do more lending and they lower rates. That's kind of how it is. Anyway, I'm Jeff Barton. There's a lot going on, as I said. I'm with you all day, every day. No, I'm not here every day. I'm here once a week, Saturday and Sunday. KCAA, great people. Thanks very much. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show each and every week. We bring to you a lot of different information, and a lot of different information sources come to us, and we just try to help you make decisions, better decisions. The reason we do that is because it's better for you. There's a lot of ways that you can go about getting a mortgage. You can listen to Uncle Joe, you can get out of the local bank at the corner, or you can do all your own research. Well, this is part of that process too. No pressure, no high sales, none of that, because the information that we provide you is something that, you know what, we spend a great deal of time going through it. And in the business 25, 30 years, I can tell you that in order to be able to make the best decisions, you have to have the best information. And in that, we bring to the show, first time on the show, Gilbert Sanchez from NP Inc. He's going to tell us a little bit about what they do there, some of the programs they offer. Gilbert, how are you?
I'm doing fantastic. And yourself?
I'm okay, thanks very much. I'm really kind of, the way the rates have been going up and down, it's like very difficult to get a buyer excited about putting in a contract if today the rates are 5.5% and next week they're at 6.5%.
Right. Yeah. That is a challenge. But you know what comes to mind is the best time to buy a house is always 5 years ago. If you look at 5 years ago, you're like, oh my God, I wish I would have bought this house. It would have been $100,000 cheaper.
Yeah.
So if you keep on I remember back in the day, I've been in this for 30 years as well. I remember when I first bought my house, rates were at like 8.5%, 9%. And when it went to 7.5%, I was like, wow, So right now the rates are actually still pretty good. I mean, just people got spoiled with the whole, 2%, 3% thing.
I agree.
Was just a false, let's say, state of mind, let's say.
No, I agree. Anything that we talk about on the show, whether it's non-QM or non-traditional borrowing or just your conventional loan, always centers around, and borrowers will do this, around the rate. And we try to always say, look, it's about, can you afford the monthly? And what you said was great. 5 years from now, you're going to wish you bought the house today because the equity you're going to build in it is going to be substantial.
Exactly. And that happens year and year around. So one of the biggest things is I focus on non-QM lending. So non-QM is non-qualified lending. My rates are actually probably a little bit higher than what the norm is. Let's say normal is, conventional FHA and things like that. But a lot of people don't qualify that way. So that when the mortgage brokers that have because I'm a wholesale lender, when they have my product, so you need to verify income, or if there's something wrong, or 1 year wasn't good on taxes and you only need that 1 year tax return, we can do it on our programs, and at least you qualify and you lock in that sales price of that house. Everybody thinks it's going to be like a shortfall, this and that. I'm living in Miami, and I can tell you South Florida, I don't think it's going to be going down at all.
Miami is one of the cities in the U.S. where prices have really continued to climb. I think 13% last year. It was pretty amazing. Right. Way that Miami's real estate has really skyrocketed and continued to do so.
Exactly. I think they're going to stabilize a little bit more, and just people are going to keep on moving to sunny Florida.
Okay, tell me a little, Gilbert. I'm sorry to interrupt, but just tell me a little bit about some of the programs. Now we know about DSCR, we know about bank statements, we know about TIN loans. What do you specialize in, or maybe it's all of those things?
Well, I specialize in all of them.
Okay.
Like I said, I've been in this for 30 years. But one thing about the DSCR, I see a lot of people out there on Instagram that it's just so funny because I reply to them all, and they're all saying, that the rent has to equal the payment. In reality, I have programs that the rent doesn't have to equal the payment.
Right.
So DSCR is debt service coverage ratio. All they do is divide the rent, the going rent, by the payment. And if it covers, that's the 1-to-1 ratio.
Right.
Like in our bank, we can go below that. We can go down to 0.75. And if it doesn't even get to that, we can actually do a no ratio, where you don't have a job on the application, you don't have income on there, and you don't even deal with the rental aspect of it. But I mean, obviously, it's going to be at 65% loan to value instead of 80. And then on the flip side, let's just say that does happen. I have other programs such as bank statement program. I have a 24-month bank statement, a 12-month bank statement, and a 2-month bank statement program. And the beauty of that, the rates are actually almost like conventional, and you don't need to verify income the traditional way, like by taxes. What you do is that's more for a self-employed borrower. That what they do is they average out the last 12 months or 2 months or whichever, if it's 24, it's 24. They average out the income and they have an expense ratio. So that's how they come up with your income. But that rate right now is just spectacular. So if you have something that you can't verify income, I mean, we have the product.
Excellent. Now, NP, you've been around for a while out here in California?
Yes. NP's we're approved in almost every single state. I think 48 states. There's a few that we don't do, maybe Vermont or something like that. But we're approved in almost every other state, yes.
Okay, excellent. And locally, do you do most of your processing from Florida, or do you have local here in California? Or how does it all work?
Well, our main office is in Boca.
Okay.
And we have a lot of people since this COVID thing happened. We have a lot of people that just work off site. They don't even work there. So I can have somebody in California working for me, and it works seamlessly. Everything of mine is online, so it's you call me, I verify. I do the pre-qualification, and I'll get you to do the submission all on Zoom, Teams. So it's not like if I have to be in your neck of the woods, let's say.
Well, most of the business done nowadays is done either through a Zoom, a telephone call, a text. There's very, very few in-face, person-to-person meetings of any of the loan officers that work at Malibu Funding, the company that I work for and it sponsors the show. Yeah, those things. It's usually about, in a hot real estate market, it's usually about speed. You just don't have time to do it. You want to get the application in, you want to get an approval, you want to get DU, you want to get it all to the prospective sellers so that you can get first in line when they're selling the house.
Exactly. And speed is the key. I mean, I've closed, actually with your loan officers, I've closed loans anywhere from, the fastest I think I've closed was probably in 13 days I had it from application to close.
Oh, that's fast. Yep.
Yeah, and that's fast. So, not every single file is going to go that way because some people drag their feet. Some things we need and you can't get them or whatever the case is, or the appraisal takes longer or whatever. So, and an average, let's say, is 30 days, that should be enough time to close unless if there's a problem that we need to take care of. It might take a little bit longer. Now, but speed is definitely the issue right now, yeah.
Yeah, it is. And in one of those respects, I remember, this is probably going back 10 months ago, appraisals were a problem, and they were a problem just simply because there weren't enough appraisers to do the appraisals out there. Now I think it's probably in a reverse way. How do appraisals account for value of a home in a declining market, and how have you seen that affect what you're doing?
I haven't seen too much of the declining market, but I'll tell you what's going to happen. If an appraiser, like in Miami, you're probably not going to have that issue. In South Florida, you're probably not going to have that issue. Mm-hmm. But I don't know, somewhere else may have that declining market where, the sellers were selling at a certain price and now they're not selling it, so they're reducing their prices for quite a bit. It has to reduce by a certain percentage. Anyway, so what happens in a declining market, if there's a declining market and the appraiser actually checks off declining market, you're going to get hit by 5% on the loan to value, meaning that if I can do 90% on one product and I'm in a declining market, you're now going to do 85%. So the borrower's going to have to put 5% more money.
Now, as a rule, in terms of pricing out loans, knowing obviously that you have the matrix to be able to just solve problems by doing what you just said, that bespeaks to me that you've been through this before, meaning that not only the company but yourself, you know what's happening, and getting with people like you for somebody who's new, like a first-time home buyer, is really a benefit. And that's one of the reasons I think companies like yours are good for the marketplace, because there's no rattle, there's no panic in whatever the market conditions are. There are solutions that are tried and tested in order to solve problems for borrowers.
Absolutely right. It's funny. I'm like the the problem solver. So yeah, every time there's a problem, like mortgage brokers usually come to me and they're like, oh, we can't get this done or whatever, and it's kind of like a puzzle, kind of like a puzzle that changes shape every single day.
Right.
So every time you turn around, there's some new information. But like yourself, you've been in this business for 30 years. I've been in this business for 30 years. So there's so many ways of getting things done.
Right.
That a lot of times with experience you figure it out. So it's highly important to get with somebody that has experience.
Gilbert, we're at the end of it. I'm sorry to say this has been a joyful conversation, really eye-opening. You mind sending out or telling people how they can get in touch with you directly so that if they have some questions on what you're talking about, that'd be great.
Sure, definitely. My email is gsanchez@npinc.tpo.com. I'll repeat that. Or my phone number is 305-724-3414. Once again, it's 305-724-3414.
Gilbert, thank you very much again. We'll do this soon, and I appreciate it. Let's hope the market continues to be strong down in South Florida and certainly turn around in the rest of us. Out here, we really need some help.
Phenomenal. Yeah, definitely. Well, I'm here to help, so anything I can do, please reach out to me. I'll help you any way I can.
Thank you very much. That's Gilbert Sanchez from NP Inc. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. We come to you once again each and every week to try to bring you some solutions, some answers to questions that are out there about, how am I going to get this house? What is the mortgage going to cost? What are the rates? I'm going crazy. Am I going to keep my job? What's going on? Yeah, that's what we do. We try to calm you down, get you straight on what is happening today, whether it's in the macro world of the greater economy or world events that might affect how a lender treats you, whether the actual money that you're going to borrow from them is easier to get or it's harder to get. I mean, these are some of the things that we deal with on a big area, and then on a smaller area, we deal with individual programs from individual lenders. People who really know their business because the companies that they work for, that's what they do, directly to you and to the mortgage broker or whoever they work with in order to get the borrower, you listening to the show, the best rates and the best programs out there. To that end, Ken Van Camp from Plaza Mortgage, as well as Tim Conwell from Plaza Mortgage, join me now. Gentlemen, how are you?
Fantastic. Thanks for having us.
No, thank you. Jeff. Thank you, Ken. I appreciate it very much. Ken, just first off, you've been working at Plaza Mortgage for some time. Now, Plaza has been around a long time. I keep reading where newer and older lenders either dropping out of the business or like Homebridge I saw at the beginning of last month, they sold out in their retail. How are you all fixed over there for long-term success?
We do take the long term into consideration, and that's why we have a really broad product line, and we're actually hiring right now. So while other lenders are running away, we're beefing up.
No, that's excellent. And I appreciate that because stability is what a borrower wants to know. They don't want to come to, some understanding, we lost our credit line, which is what used to happen back in 08 and 09. Sorry, we don't have any money today. You're going to just have to wait. It's nice to know stability is really at key over at Plaza. And I've been doing business with you guys for, 10 years plus probably.
Yeah, we've been around since 2000, so we're 23 years in.
Right.
So we've seen the up and down. One of the good benefits is we're privately held, so we're not answering to another group of people, and we also only do wholesale, so we're only in the wholesale channel, which allows us to focus and actually gives us a lot of stability.
That's an excellent way to look at it. Let's talk about programs a little bit, if you could, Tim. What's going on there in terms of your product line? You said you do all kinds of programs. Give us a couple examples of things that not only are working for borrowers, but might be able to be a solution for some of the people out here in the Inland Empire in Southern California.
Absolutely. The two big things that we've really seen recently has been a big growth in renovation loans.
Right.
There's a lot of different renovation loans out there, whether it's VA, USDA, But, for as far as California goes, the Freddie Mac program that allows the ADUs even to build and add an ADU onto your property has been a really strong product for us. That and then the DSCR programs. A lot of people are looking to get into investment homes. If you're, buying an investment home in a vacation area, we have a program where we can qualify nightly rentals with a software called AirDNA. And it's actually a pretty straightforward, simple way to kind of get into the investment world.
Interesting. So in terms of the pricing for both that product and the product you mentioned earlier, we see the rates like volatility and the rate volatility and the way that prices jump around. How are you fixed for, let's say, something like a DSCR loan, which is not a non-conventional loan anyway? It's more like a hybrid type loan versus what would be considered conventional type loans, 30-year fixed rate, 20% down type loan.
Right. Okay. Great question. So on the conventional side of things, with the rates, they've settled a little bit and have been kind of hovering in the mid fives.
Right.
Today 6.52 is the average conventional across the country.
Right.
But we've been kind of hovering in the upper fives, low sixes lately. On a regular conventional, when you're getting into the DSCR loan, like you said, it's a non-QM loan. It doesn't use as much to qualify. It's much higher risk. You're looking high eights, low nines, depending on the down payment on it.
Okay, so walk us through a little bit about that DSCR program. I'm always fascinated with it just because I know that if you're out there and you're trying to build for long-term financial security, you're looking for residual income, something that you don't have to be, 9 to 5 in it every day so that you can afford your retirement when and if that comes at a reasonable age. What are the qualifications for the DSCR and how would you walk somebody through that?
So the DSCR loan is really interesting because it's a business purpose loan, which is unlike most of the loans a traditional mortgage company like us would do, a traditional lender.
Right.
So the DSCR loan, the qualification is really just based on a decent credit score and what the rent payment is versus the mortgage payment. And as long as that's equal to or greater than 0.1 or 1, that's the qualifications. Usually you need to have some sort of history of rental. You can do it as a first-time investor. It just takes a little bit more money down.
I see.
So it's a fairly easy program to qualify as long as you've got your payment to rent ratio makes sense.
Do you require that the rent payments go directly to you, or does that all get handled direct from the borrower and they just pay you directly? I know some programs require that the payments go direct, but they probably, what do they do for you?
No, on these, the investor's going to make the payment. The investor, whether it be an LLC or an individual, they're going to make the payment to us. It's on them to collect the payments from the investors.
So you do take loans as an LLC as opposed to an individual, or do you require
on this program? Yes, absolutely. On this program, like I said earlier on, this is a business purpose loan, so it's a little bit different. Right. It doesn't quite have to follow the same kind of QM rules that other loans do.
Right.
As far as utility and that kind of stuff.
Right.
So it's a little bit more flexible on the qualifications of it, and it can be an LLC. Yeah.
Okay, so you follow the economy and what's happening. I don't know if this dreaded recession is ever going to come or not going to come. We talk about spreads in the bond market and how that's affecting whether the mortgage rates are going to go up and down. What do you all read? And maybe we can get Ken's opinion on what exactly where are we heading in all this? Is it still undetermined and so we play it by ear? What do you think?
Well,
I don't think...
Sorry, go ahead, Tim.
I was just going to say, I really think that it's leveling out now, finally. I think that we are going to see that we're in a recession or they're going to announce a recession. I think that, probably in the next quarter or two.
Right.
But I do think that rates are going to kind of level around the fives.
Right.
I think we may see a little bit more increase in the housing market throughout the rest of this year. But then, they're predicting early next year that values may go down a little bit, but, rates will probably follow. That's sort of the stuff that we've been reading.
And
that's what I've been reading too. Yep. Okay,
so and it's so funny because depending, and I'm an avid watcher of all of the financial programs from Bloomberg to CNBC to MSNBC to Fox News, anything that I can get my hands on that tells me what's going to happen. And you know what? There's no consensus. It's very if you're a consumer looking at these things, trying to figure out whether you should buy or not buy, what are you telling people?
There's never a bad time to buy a house. there's never a bad time to buy an investment property. If you can qualify and it makes sense for your pay, get in. Get in when you can get in.
Right.
Listen, if rates go down in 6 months, 9 months, or a year, 2 years, you can always refinance. But, the equity of the home, you rarely ever lose that. That's there. That's permanent. It's a solid lifetime investment.
And where are you guys based right now? Are you in Southern California? Where are you? Back east?
The company's headquartered in Southern California. I actually work out of our second headquarters on the East Coast, so I'm actually in Jacksonville, Florida.
Okay.
Ken's located in Michigan.
Okay, so in both of those markets, very different markets, right? Florida seems to still be booming, about 13% rise in Miami real estate last year. And up in Michigan, we're not quite sure what's happening, whether the snow's going to melt and everybody's going to float away or what's happening. It's kind of like that here in Southern California. Now, we've had unprecedented growth, but at the same time, people are nervous out here. So trying to get a read from you all, who are the experts in the field, how is volume? Do you see volume picking up? Or, as you said, we're just treading water for a bit?
Volume has absolutely picked up for us.
Okay.
And I think it's picked up across the board for a lot of people.
Okay.
There seems to be a magic number out there, right? So if you could be doing loans in the fives, a lot more people qualify.
Yep.
When you get loans up into the sevens, you lose a significant number of people that would actually qualify for that mortgage.
Yep.
So as rates have kind of trickled down over the last, a month, really, we've seen a drastic increase in volume. So to us, it looks like we're excited about spring buying, spring moving. I know there's a new consumer price index coming out Wednesday, which will kind of determine where rates go next.
Right.
Strong feeling that they're going to either hold or dip a little bit, and hopefully really encourage some strong buying in the spring, which is a great opportunity for consumers.
Ken and Tim, thank you very much for coming on the show. We're up against the clock, but I want to give people an opportunity to contact you directly. If one of you or both of you can shout out a way to do that, that'd be great.
Go ahead, Ken.
My cell phone's the best way to reach out to me, a text or even a call. My number is 248-508-4249.
Okay, that's Ken Van Camp. He's at Plaza Mortgage. Tim, you want to chime in, or are you going to leave it the way it is?
Absolutely, yeah. So my name is Tim Conwell. I'm the division vice president here at Plaza Home Mortgage, and you can call me on my cell phone as well at 904-535-0923.
Gentlemen, thank you very much. Let's do it again soon. Love the answer and the enthusiasm. I love the fact that you guys think market's going to be great. Thank you very much for coming on the show.
Thanks for your time. Appreciate having us.
Thank you. Thank you, Ken. Thanks. That's Ken Van Camp and Tim Conwell from Plaza Mortgage. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Okay, earlier in the show, I talked a little bit about commercial real estate and about what happens in markets like we have now and what happens overall when the economy changes and the way people's lifestyle changes and the stay-at-home crowd. So I'm just going to read a little bit of what this Swampa Ramsawama from USA Today said in an article I read yesterday. PIMCO defaulted on loans in buildings in California, New York, and New Jersey. Brookfield, which is the largest office owner in L.A., defaulted on 2 buildings. The dwindling demand for office space, small and medium-sized banks account for 80% of commercial real estate lending. Prices could fall 40%. Okay, that's a mouthful right there. Joining me is Tyler Sinks, and he brings us his professional opinions from Tyler. What's the name of your firm? Furcadia down in San Diego. He's been down there for a number of years. I think, 10 or 11 years you've been there?
Yeah, something like that.
Okay.
Yeah, 11 or 12, I think, at this point.
Okay, so you heard what this guy said from USA Today. Obviously, news is news. What's the situation down in your neck of the woods, and where do you see it heading?
Yeah, well, thanks for having me on, Jeff.
Sure.
I'd say this. I'd say that the apartment world, which is kind of where I spend most of my time with multifamily,
Right.
is still relatively strong. San Diego has fared a lot better than some other markets, primarily because pricing didn't kind of fluctuate nearly as much as it did in other parts of the country, like Phoenix or Tucson, Arizona, or Las Vegas, some of the boom-bust markets.
Right.
So, San Diego has kind of weathered the storm recently fairly well, although obviously we're not immune to the interest rate hikes by the Fed. So we are seeing pricing beginning to kind of turn over a little bit. I'd say kind of year over year, we might be down maybe 10 to 15%.
Okay.
Which is a bit of a change. I mean, obviously the last, decade plus, we've seen prices continuing to appreciate. So to actually have prices kind of go the opposite direction for the first time in a while is a little shocking. But relative to other markets, I'd say that, San Diego and Southern California, for that matter, are definitely faring far better than some other parts of the country.
Okay, so as prices go up, what happens to the cap rate? And if prices go down, what happens to the cap rate?
So as prices go up, cap rates go down. They're inversely related.
Right.
And basically, the cap rate is really more of a function of interest rates.
Uh-huh.
Interest rates were so low during the pandemic and post-pandemic, with the Fed keeping rates near zero, all the stimulus money, Treasury bond purchases monthly by the Fed. It really made financing costs extremely, extremely attractive and cheap. Not too dissimilar from what we saw in the single-family home market, where you could go out and get a mortgage for 2.5%.
Right.
The same was true for commercial and multifamily. So that bid up prices very quickly. It felt like every day prices were moving so quickly that a price yesterday looked like a good deal the next day.
Right.
So prices moved up very quickly, but just as soon as we got this, rampant inflation and the Fed began raising interest rates about a year ago, we've started to see the market kind of go the opposite direction as financing costs has gotten very expensive. And at the same time, rent growth has also slowed down a lot, and that's probably something that shouldn't be overlooked. Rent growth has really kind of kept the party going for a lot of these apartment and commercial real estate owners. And as rent growth has started to sort of table off or even sort of dip, that's also kind of been another headwind for the commercial real estate world. And then you have things like office space that's been vacant with remote work and folks
Right.
not wanting to come back to the office. So vacancies ticked up. Some of the urban multifamily in like downtown LA or downtown San Francisco, downtown San Diego, et cetera, is sort of suffering now because those workers are no longer living and working in downtown. They're choosing to live in the suburbs or other parts of the country that are less costly.
Now, in San Diego, do you find a lot of apartments in general in the downtown area? I didn't think there was that many. Maybe there is. Tell me.
Yeah, so downtown San Diego has seen quite a bit of a renaissance in the last decade or so.
Okay.
There's a couple thousand apartment units currently under development in downtown San Diego. There's been a few that have come on recently in the last year or so as well. So there's been a pretty big resurgence, mostly on the supply side in downtown San Diego. So if you were to fly into the airport or drive to a ball game at Petco Park, you'd see 15 to 20 cranes in the air downtown. 90% of those projects are multifamily projects.
I see. And these projects have probably been in the work for 10 years, right? I mean, just to get entitlements through and to begin construction probably takes you a good 4 or 5, 6, 7 years.
Yep, exactly.
And in the amount of apartments coming online or supposed to be coming online, does this really put a dent in what you need in terms of total housing units down there? Is San Diego one of those cities where you just can't keep up or catch up to what the needs are, or is it just the opposite? You have more than you need?
Yeah, I think that narrative is definitely maybe a little bit overblown in certain circumstances. I think there's definitely been a housing shortage for sure, given primarily by the fact that we haven't built enough homes since the GFC in 2008.
Right.
But at the same time, this year is a record amount of new supply coming online nationwide. I think it's a 40-year high. We're going to have more new units of housing coming online across the country than we have since, I believe, 1986. So this is going to be a massive year of new supply, not only for single-family homes, but multifamily units. And that, again, coincides with the higher interest rates and rent growth beginning to flatten out. On top of that, input costs like materials, labor, construction, all that's stayed relatively high and really hasn't corrected much. So it's going to be a very interesting kind of 12 to 18 months as we look ahead on what happens with all this new supply, how that affects the current inventory, and what that does to vacancy and rental rate.
Now, you do mostly rentals or mostly purchase or both?
So our firm, Berkadia, we do two things. We finance apartment purchases or refinancings, and then we also sell apartment complexes. And generally, we do anything from 10 or 15 units all the way up to 1,000 plus units.
Wow.
And so we're really kind of more on the sales side of larger investment properties.
In the way that inflation is calculated and how we see whatever it is affecting your business affected by the prices going up, when you're financing properties or looking to sell, how do you consider that particular aspect of the sale or purchase? Do you look at it and say, okay, we have to discount, or do you look at it and say we have to increase?
Well, I think it's generally believe that inflation is a good thing if you own real estate.
Right.
Real estate's generally an inflation hedge. The nice thing about multifamily is you have short-term leases with all your tenants. So as inflation goes up, you can turn those leases over on an annual basis and raise rents. The problem, at least in California, is now we have a lot of these rent restriction and rent control laws. So it's the government's made it a lot harder to kind of keep up with the inflation and use inflation as a hedge. But generally speaking, I think people will view inflation positively if you own real estate or multifamily units or commercial buildings or what have you. It's generally viewed as a hedge, so it's a better place to put your money than somewhere else where you're theoretically going backwards. So,
who is the major owners of properties down there? Now, when you were talking about adding more units, you're really talking about rental units, right? For the most part.
Yep. And a lot of the big developers are household names like Irvine Company, Donald Brenn's company. He owns thousands of units in San Diego. There's a few large local players as well. Institutions, REITs, Blackstone, groups like that. They have a lot of projects in the pipeline. So San Diego has really been sort of a bright spot relative to other parts of California.
Yeah, I agree.
We're seeing a lot of the influx of capital from San Francisco or LA, investors that used to invest there that for one reason or another wanted to take their money down to San Diego. So San Diego's fared, fairly well during this whole kind of post-COVID era. So hopefully that continues, and I think California is definitely still a good bet long term. Although there are some headwinds, mostly from the political and the regulatory standpoint, that we still have to navigate. So
yeah, that's a good way to put it. Navigate, right? Exactly right. I mean, just trying to stay out of the way of the regulators is what we try to do always in the mortgage business. So I assume it's the same way in development and sales of commercial down in San Diego.
Correct. Yep.
Well, Tyler, thank you very much. We're up against it. I really appreciate you coming on the show. You always give good information, man. I'm overwhelmed. I want to go home and think about it now. But thanks for coming on. I really appreciate it.
Thanks a lot, Jeff. Appreciate it.
Thank you very much. And could you, Tyler, by the way, send out a way by which people can get a hold of you, telephone number, email address, something?
Yeah, sure. So my email is Tyler, Tyler, .sinks, SINKS, at Berkadia, BERKADIA.com. You can also look me up at Berkadia.com. I sit in the La Jolla office down here in San Diego, and happy to help with anyone with any apartment or commercial real estate related needs.
Excellent. Thank you very much, Tyler. Thanks for coming on the show.
Thanks, Jeff.
Thank
Bye-bye.
you. That's Tyler Sinks, and he works at Berkadia. And I am Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. If you want to see the show, obviously, go to YouTube. We also have a great website. It's themortgagevoice.com, and you can go there, see all the guests or a bunch of the guests that we have on, contact them directly here and see a little bit of what we've done in the recent past. Also, we have a number of podcasts, several of them, many of them, and I think, Darryl, you have a list of those for us?
At least a couple of hundred, yeah. Apple Podcast, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, And podclips.io.
Podclips.io, great place to go to centralize your podcasting. I know if you hear and see anybody, a lot of, we're on terrestrial radio, which means that we are broadcast. It's quite a bit different than podcast. Now, to anybody under a certain age, there's no difference. Podcast, broadcast, they don't know the difference. So I often get referred to as a podcast. Now, we have podcasting abilities, but primarily we are a radio show, driving around Saturday, Sunday morning, going to the hardware store, maybe coming back from church or wherever it is that you spend your Sunday mornings and Saturday mornings. Hey, you can turn on the radio, KCAA, Inland Empire, great bunch of stations, both AM and FM, that you can catch our signal and our show. And that sets us a little bit different, a little, like I say, in the old days, AM days, back in the 60s and 70s, driving around in your car listening to AM radio was awesome. And so returning that to your car rather than on the Sirius FM sort of way to go, or the Sirius satellite way to go, we're broadcast. So you can tune us in on your little transistor radio. By the way, do you have a transistor radio anymore?
Absolutely.
Okay, now I don't. I tried to buy one. Can't. It's all
pawn shop.
Yeah. That's a good one. The pawn shop.
Pawn shop.
Oh, man. Okay. So if you're out there and you're listening to me now thinking, what the heck? You're right. What the heck? But I loved going to the beach, turning on AM radio and listening, yes, that's right, to a baseball game. I loved it.
Vin Scully was the voice of summer.
Oh, it was it was great. We don't have that kind of thing anymore. Everybody's got their own private, bank of music and whatever else they want to listen to, and they put on these very large headphones, and you can talk to them and they have no idea you're talking to you back. Anyway, let's get right back to the show. You want to say something, Daryl?
No, I'm fine. I was thinking of poor Vin Scully.
I know.
Vinny.
I
miss was your friend.
He was your friend. It was like somebody in your living room that you could just, invite over, and it was like you were having him over in your house, just talking to you about stuff that was exciting and fun. And
kind of like listening to Jeff.
Yeah. Well, he was much more skilled at it than I could ever hope to be. And let's just get to a little bit more of what's going on before the show closes out. Okay. Jobs report, 236,000 jobs created last month. Now, they say that jobs report is actually in line with what the average had been for the last 12 months, which is pretty good employment. It also portends that the Fed will continue to have the green light to raise short-term interest rates, meaning that their attack on inflation is not yet complete, and they will continue to do so. Now, we may be killing what they call the equities market, stock market, right? If you have either in your 401k or your company retirement or in your portfolio of stocks that you have either through an investment in something, or you have an actual stock person that does this for you, you're not a happy person. Why? Because the market is flat, or it's really down, or if you're in a particular sector, i.e. the real estate sector, REIT sector, or the tech sector, you're getting hammered. So you're trying to figure out a way by which this is a good news. But if your inflation bit, and by the way, anybody looking at gas, I just don't think it's inflation. What I think, and I've said it many times before, is that sometimes large corporations take advantage of things that really they shouldn't be doing, especially somebody who needs to get to work and they have to drive their car, and the gas is now back up to $5-6. I went to a place today, $6.15. I was like, how can this be possible? How is that possible? It just drives me absolutely insane. Okay, so the Consumer Price Index looks like we're going to have 0.3% increase year over year at month over month, and at about 5.2% annually. That's down, but not down enough. Now, when we were up at 9%, this is going back 6-8 months ago, 9% inflation, and we were just freaking out that the inflation hadn't been this high in 41 years. Well, it's been cut in half. Now, as I was saying about the oil companies, I think there are many, many, many companies out there, not just a few, but are looking at the situation and saying, hey, let's blame the workers because we have to pay them more money for raising prices. Let's blame the supply chain. Let's blame. I just think there has to be more to business than just, and I'm not an Ayn aficionado here. I'm not the one that says, hey, altruism is not the way to go. No, I would say that as a business model, that is the only way that you can go, especially when we have so many people hurting out there. I mean, you may think you're doing okay, but look down the street, look around the corner. There are a lot of people who are hurting out there, and inflation as well as, other things rising in costs really hurts. So I'm one for a little bit more altruism, a little bit more less seeking profit than some others. Now, don't get me wrong, capitalism's great. I've been living my whole life on it, so that's not the issue. It's just, hey, come on, let's help somebody else out there. Okay, the SVB Bank and the Signature Bank failures fades into the minds of the public. This is what happens when we're on, I guess it started, maybe 5-10 years ago. We have crisis after crisis after crisis. And speaking of that, anybody see the latest of mass shootings out there? So I went in and looked at the 5 different people who were shot, and just, it's unbelievable. It's too much. It's unbelievable. I know there's an answer to it, and I wish people could figure that out. It's just horrible. But we seem to jump from crisis to crisis, either economic crisis, banking crisis, mass shootings, and it's just on to the next thing, on to the next big thing. We, have all these different things that happen and occur, and we can't seem to focus on any one of them to solve any of these problems. And there are major, major problems out there that need to be solving. 1 is housing affordability. 2 is houses in general. Where are they? How come we're not building any? Why is it that all of the builders out there have gotten such cold feet because they don't want to get caught like they caught in 2004, 5, and 6, building too many, and then all of a sudden they're hurting in 7, 8, and 9. I get that, but at the same time, if we're guaranteeing depositors from banks that really are SVP for one, Silicon Valley Bank, which are really major players in the equity business that aren't general depositors, if we can guarantee their particular deposits, why can't we help out the housing builders or help out somebody in order to build more houses? Because the more houses, the prices will come down, and people who are working, and by the way, there's 62.2 million people working in the workforce. 62.2% of the people working in the workforce, and between 25 and 54 ages, 82% are in the workforce. So we don't have a lazy country. We don't have a bunch of people sitting around trying to collect. No, those are all hype and hyperbole. Look to the people who are doing the basic work that keeps the country going, keeps you going, keeps me fed. All the people who are really doing that, yes, they deserve to have a way by which they can afford a house. I read an article yesterday, I forget where it was, maybe Yahoo, I don't know. A couple making $200,000 a year. And they were saying they were laughing because they can't afford anything in Southern California. Now, San Bernardino, Riverside counties, you know what I'm talking about. I mean, I'm looking at down payment assistance programs to help people making $180,000 a year. That doesn't make any sense. You should be able to save and be able to put a down payment down on a house making $180,000 to $200,000 a year. You just should be able to, but you can't. Even in those communities, down payment assistance programs, and one of the favorite ones in California, the CalHFA program, just went bust in terms of the amount of money they're able to lay out for those people who are into the 20% program. That's right. We had it last week. We had Tomas Trujillo on talking about the 20% down payment gift that they were giving you in the CalHFA program. Well, I think there was, I don't know, what did they say? 2,000 loans that could have been done through that program according to the amount of money that was available, and ran out of that money in like a week and a half. That's just unbelievable. Obviously, there's demand for it. Obviously, people need the money in order, even if you're making $200,000 to afford a house in the IE, San Bernardino, Riverside counties. Okay, that's a big soapbox. I'm going to get off it now. Go back to my guests who really know what they're talking about. I'm Jeff Barton, your voice in the mortgage industry. Thank you very much for tuning into the show, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.